Hello and good morning, everybody, and welcome to the latest edition of the Novia Global Pulse Advisor webinar series. My name's Paul Foreman, and I'm delighted to say that we're joined today by our friends at Marlborough Investments, who are represented on the platform with their multi-asset strategies. With us today is Nathan Sweeney, and I have to say I shared a stage with Nathan in Portugal last week, and it was so good I volunteered to do it again a week later. So no pressure on you there, Nathan.
Thank you,
But
Paul.
at the moment, there's a whole host of noise in the markets, and Nathan's going to run through with some slides today just to show how you can cut through that new noise and find the true fundamentals underpinning the current market movement. So with no further ado, I'll hand you over to Nathan. And as we go along, if you want to ask any questions to cover off at the end, please feel free to do so using the Q&A tab at the bottom. So over to you, Nathan. Thank you.
Thank you, Paul. Good morning, everybody, and thank you for taking some time out to join us today. So as Paul mentioned, I'm going to be talking through what's happening in markets and cutting through the noise to explain clearly the drivers behind markets today. So one of the things that I'm going to start with first is just a quick recap on performance. So just looking at year-to-date performance and performance actually versus 2024 and over the last quarter, so Q3 performance, just to give you a little bit of context. And really, if we look at this, we can see particularly last year, we had good performance from US equities. And there was a lot of talk about US exceptionalism coming into this year, but it really didn't start with a exceptional tone this year, particularly US equities. But we are seeing better performance since Liberation Day and good performance coming through for the third quarter of this year. China also really stands out. So Asia is starting to really come back to life with good performance year to date and following on the back of good performance last year. I think the standout asset class has been gold. And there's been a lot of talk about gold over the last couple of months, and we've seen it hitting all-time highs. And we saw a bit of a retracement in gold. So we can talk about that a bit. But I think the big question is around AI and are we in a bubble? But that's something which I'll look to address as well. So what I've done is I've split it out into a couple of sections. So the first thing I'm going to talk about is unreliable data. So we live in this world of AI, and yet some of the data which we rely on day to day is not that reliable. So that can create volatility in markets. So that's something which I'm going to focus on. Then the second thing is transactions speak louder than words. And ultimately, this is just down to the fact that we're moving more towards a transactional government, particularly in the US, and are other governments following suit? And what does that mean? And then lastly, what do we expect going forward? What will be the key drivers of markets? And just to give you a bit of context. So I'm going to start with unreliable data creates noisy narratives. And the way I think about this is, data fundamentally moves markets. We have these data points that come out and markets react and investors react. And the question is, should they react to the extent that they do? And I'm going to give you one specific example. So there's a data point which is produced in the US by the Bureau of Labor Statistics. And they came out a couple of months ago to say, actually, look, the numbers that we've produced have been a little bit inaccurate and we want to revise that data. But the revision that they made was, frankly, astronomical. So they said, look, the data that we've been providing, actually, it's out by nearly 1 million. And this is looking at unemployment. So they got the numbers wrong by almost 1 million, which is huge. And we know that markets tend to react to these data points. So our question was not around the reaction. It was trying to understand why the data point was so wrong in the first place. So what we did is we delved into it to understand actually how does the Bureau of Labor Market Statistics actually produce this data. And we came back with some interesting information. So the first thing is that what they tend to do is they tend to take this data over 3 consecutive months. So if they're producing a data point for, let's say, September, they will collect information prior to September, in October, so over a 3-month period. So the point is that if you're a company and you're providing information into one of these survey-based data points, maybe for a specific month, you can't complete that data because maybe it's your tax year end, maybe you're launching a new product. And so what they do is they give companies a bit of leeway. So what it means is that when a data point comes out, it can be revised in the future because they don't have all of the information, which firstly I found was interesting. The second thing I found interesting was that the data, the way that they collect it varies. So the most common way that they get the information is that people go onto a portal and fill out that information. But the other interesting thing is that people are still phoning in their surveys, and some people are actually faxing in those surveys. So in 2025, some people still using faxes. So it just highlights the integrity of the data. And I think this next slide really highlights that because what it shows is that the participation rate or the level of completion rate of those surveys is continuing to decline. So back in 2015, you had about 70% of respondents or people who received that survey would complete it. And now that number is continuing to drop. And this is looking at jobs data and inflation data. And you can see that for the jobs data, there's less than 35% completion rate. So what that means for the Bureau of Labor Statistics is for the piece that they're not getting information on, they usually make up that number. So that's worth focusing on. And the other thing that I found interesting is that if you look at who is completing the surveys today, there's now some sort of skew in the age cohort that is completing these surveys. So you're seeing less and less younger people completing the surveys and more people of an older age completing the survey. So people in the age bracket of 60 plus. Now, I know that my view of the world is very different to my dad's view of the world. So what you should expect there is that there's probably some bias in the data due to the fact that you have an older cohort completing the information because they think differently and actually they're using different mediums to provide that information. So for me, what it does is it just highlights the accuracy of the information itself. And the point is that investing is emotional. And in this noisy world, when you get a data point which comes out and says, actually, unemployment is the figure's wrong, we got it wrong by 1 million, there's actually 1 million people less employed, what tends to happen is that creates a emotional response in markets. And from our perspective, it's about stepping back and being unemotional in how we look at what's happening in markets to understand the drivers. And this would be a clear example. So we would never react to one single data point. Firstly, you're looking for a trend and you want to understand the data and you want to ensure that the data itself is reliable. So I just hope that just kind of highlights that we do live in this world where some of the key information that we're getting can actually be incorrect. And if you think about Liberation Day would be a great example. So after Liberation Day, if you were a company and you were completing this survey in the week following Liberation Day, and you were asked, what are your plans for hiring going forward? You might answer that very differently than you would have the week before that. And now, where we are today, given all the trade deals that have been signed, if you were asked that same question, you would probably answer it very differently because there's an emotional element to that. So, that just this gives you just one insight into how the data today can actually drive markets and effectively in the wrong way. You can get these very short-term movements. Now we're going to move on to transactions speak louder than words. So what we've had is NVIDIA is now the largest company in the world. So most of you will have heard of NVIDIA. Some of you may not have heard of NVIDIA. But really what's happening here is, NVIDIA is at the forefront of basically supercomputing in a sense. It's enabling microchips to transact information at a much faster speed. And a lot of people are investing in this space. And there's lots of questions around, are we in a bubble? So I think I'll take that question because I expect we'll get it anyway. So if I think about where we are today and I compare it to 2000, and if I look at a measure like price to earnings, so price to earnings is one of the most common measures that people in the investment industry will use to assess whether a company is cheap or expensive. You get the price of the company. Let's say it's 100. You divide it by the earnings. Let's say they're earning £10 a year. You get a PE of 10. Now, if you have a company which PE is high, it's an expensive company. And the belief there is, let's say you have a company and the PE is 50. Your basic belief there is that the company is doing something which is going to drive really strong growth, which means its earnings will increase a lot in the future. And therefore, you're happy to pay that price today. So now let's say if I'm going to compare 2000 to today. So if I look at the top 7 companies in the US today, and if I look at their average PE, they're not that expensive when I compare it to 2000. So if I look at the average PE of the top 7 companies in the US in 2000, the average PE was 276 times. So that's a colossal number. And if you look at some of the individual names like Yahoo, a lot of people remember Yahoo Finance. You may have even had a Yahoo email at the time. Yahoo was trading on a PE of 1,123. So they were stratospheric. So what happened back then is the internet came along, and then you had lots of speculation about the potential that the internet would bring. Now, people were right. It's huge. It was game changing, but they were wrong about the time frame. And so what you had is companies who were potentially going to be big in the future, but they weren't generating revenue in the way that they are today. And so people were getting very excited and happy to pay really extreme prices for them. So that's very different today. So we live in a world where people are kind of skeptical about the potential for these companies today, which are profitable, cash generative, and are used in our everyday life to continue to grow because they're investing in a new technology, which is artificial intelligence. And so you have to remember these companies are using profits today to invest in something which they believe will drive growth in the future. So if they're wrong, could those companies go bankrupt? That's the concern. And the answer to that is no, because they're not using debt to leverage up. They're using cash that they have. So if that project doesn't work out, they'll move on to the next thing. So they're constantly investing in new projects. So we don't think that we're at bubble levels, and that word gets used a lot in today's world. It gets bandied about too much. You know, anything goes up, it's a bubble. Private equity is a bubble. Gold is a bubble. Cryptocurrency is a bubble. AI stocks are a bubble. You know, so it gets used too liberally. And you have to remember that in the financial crisis in 2007, that was linked to mortgage-backed securities. The first mortgage-backed security was created back in the late 70s. So that was a real bubble, something which basically inflates over a long period of time and gets into extreme excesses. If I was to think a bubble today, I would probably think more private credit. So I don't think that there's a bubble within AI stocks. Are valuations stretched? Sure. Are they extreme? No. Are they at stratospheric levels? Not even close. But ultimately, what you are seeing is a lot of news headlines devoted to this. But some of that has been driven by the fact that the US government is now more transactional. So it's driving business transactions to drive growth. And some of those business transactions have been with a number of those tech companies. But the belief here is that, AI will ultimately remove a lot of friction from our lives. And I'll give you a simple example. If I want to search today for a product, I'll go onto Google. I will get 8 different links. I will click through those links. I will search for my product. It takes time. There's friction. Ultimately, then I'll start reading reviews. Maybe I'll buy the product, maybe I won't, but then I'll have to fill in my password, my payment details. So there's a whole cascade of a long friction process that I need to go through to buy that product. In the world that a lot of the companies are seeing today is what you'll have is something like ChatGPT. And basically, I'll upload an image of my sitting room and say I need a new couch. It'll say, Nathan, based off the decor of the room, I'd suggest this color. Based off the dimensions I can see, I don't even have to measure it. I would suggest this couch fits. This is probably something that you'd like. I look at it and go, actually, that's exactly what I'd like. And the AI then says, I'll get it delivered on Thursday. So the point there is it's removing friction. And if you see some of the deals that OpenAI has signed, they have been with Amazon and Walmart so that their products can get into their search system. So it takes away a lot of the friction and finds exactly what you're looking for. So you're not being advertised to, you're actually getting the thing that you want. So that's slightly different. That's just one example. But if I look at OpenAI today, this is a brand new company. It generated earnings of 4 billion 2 years ago. It's on track to deliver earnings of 12 billion this year. So for a new company, it's already starting to deliver profits. So there's a little bit more behind the hype today. Now, the other thing which I think is important to kind of pick up is that we are moving more towards this transactional framework. And if I look at, this is looking at trade on this slide and trade from Asia. And the narrative, markets are full of narratives and stories, is that trade will be bad. So all of these trade deals which are being signed are going to impact China, and China is going to basically be exporting less as a result. It's going to hurt their economy, create inflation, supply chain disruption. Interestingly, if I look at supply coming out of Asia, it's actually going up. So you can see that it's not just the US who is thinking commercially. China is very commercial, and they're striking deals with lots of Asian countries. So there's still strong growth coming through there. And I think for Europe as well, you're also going to see a change in mindset. How does Europe create growth? I can see that the US is becoming very commercial and running the government like a company. China signing deals on their side. And basically this will kickstart Europe into action. So European governments can see all of this happening. They can see the fact that the US is investing a lot in AI because they believe, look, this is going to drive growth in the future. And now you can see that even in Europe, they're starting to relax some of their views around AI. Actually, we probably need to look at this technology and see if it can help us move faster. Productivity growth. And that's why you're seeing initiatives like spending on defense, which will drive growth. This is a necessity as well because of what's happening with Russia and Ukraine. But it is just an example of how Europe will come together in a more commercial way as well. So I suppose that the point there is just on that, is that you're starting to see more transactions. And one last point is that I did talk about in one of my presentations recently about Florence. And in Florence, back in 1250, basically you had an explosion of growth, and a lot of that was linked to money, the creation of the florin, the gold coin. But one of the other things which drove productivity at the time was the creation of glasses. Now you can imagine if you're working as a baker or anything, an artist, and then suddenly your eyes start to deteriorate, that's the end of your career. Now suddenly comes along glasses, and it can increase your productivity for a longer period of time. So you can imagine what kind of productivity jump you get when suddenly swathes of people can now extend their working life for 10, 15 years. So that's a productivity pickup. And so that's the expectation for AI. It just creates more efficiency, which creates this productivity pickup. And I don't know if anybody's used any of the language models, but for me, certainly, I feel it has helped my productivity. It's definitely jumped up a notch. And that's the expectation. It increases productivity, increases profits, and drives growth for the economy. So that's where people are thinking this is headed. Okay. So where from here? So what do we expect to happen? I think the key focus has really been on inflation. So we've had this huge bout of inflation over the last couple of years. Inflation has started to come down, and then we've had this fear in markets over the course of this year that inflation is going to surge back up again, particularly because of Liberation Day. And all of these tariffs will create supply chain disruption and increase costs, which will increase inflation. And I'm just looking at the UK, but you can kind of apply this to anywhere. So this is just UK inflation. But we did see during the summer inflation starting to pick up in most regions. It came down towards the back end of 2024, and then coming into this year started to rise again. But a lot of that was linked to just seasonal demand. You get seasonal demand all the time. And you also had one of the hottest summers we've ever had on record, which did impact things like crops, which led into an increase in food inflation. But specifically in the UK, it was linked to hotel and airfares going up due to Oasis gigs. So you can get these kind of seasonal impacts or one-off impacts because of demand for a certain thing. But food prices also went up because you had one of the driest summers on record. But the point about that is that changes because the seasonality changes as well, and then you get a summer which is a little bit wetter, and et cetera, et cetera. But the point being that we are not materially concerned about inflation, and neither are central banks. I think one of the other key things that people are concerned about is government debt. So we have governments who have really, really high debt. And the way to think about it is if you have debt and you have no growth, you have no way of growing yourself out of that debt. So that becomes a problem. So from the US perspective, they have a lot of debt and they're very aware of it and they want to tackle it. So this is why they're looking to spend on initiatives to drive growth in their economy, because if you're growing faster, you can have your debt because you can pay it off. You can afford to pay it off. So that's the strategy. And one of the other strategies that the US government has come out with is that they are going to link the US dollar to a stable coin. So this is a cryptocurrency or a digital coin whose price is linked to the US dollar. And what they will do is they will provide collateral for all of those currencies, those cryptocurrencies. So every cryptocurrency that's issued or stablecoin that's issued will be backed by a US government bond. So if people start using these stablecoins to transfer dollars, which they're using in a lot of countries, particularly emerging market countries, because they are very fast to transfer and very low cost. So it's a very simple way to transfer US dollars. So the US dollars are linked to these stable coins or digital currencies. But for each stable coin that's issued, it's backed or collateralized. The collateral linked to it is a US government bond. Now, people are concerned that nobody wants to buy US government debt anymore. The Chinese aren't buying, but the US has now engineered a way for people to buy it. It's created new demand by linking its currency to digital currency. And so what you should expect to see is governments around the world beginning to do this as well, other governments. So my point is that people are concerned about government debt. This is a way of helping to ensure that you have money coming in to buy your government bonds. But then also on the flip side of that, that you're looking at ways to drive growth, to be able to pay off that debt. And then you're also looking at technology solutions. How do I bring tech into any business to make it more efficient to reduce my debt? And that's the strategy ultimately. Now, if I look at the UK, there's been a lot of talk about UK debt, and we've got a budget coming up and concerns that maybe this is a Liz Truss moment if the government tries to spend too much and government bonds rise up a lot. But if you look at the price that government bonds pay you today, if you look at what's in that, basically it's made up of interest rates and inflation expectations, and there's not much else. So let's say interest rates are 4% and inflation over the next 10 years is expected to be 1-2%. Basically, that gets you your 30-year government bond price or your 10-year government bond price. If there was anything else on top of that, that would be market fears that the government might not pay you back your money. So let's say that interest rates are 4%, long-term expectations for inflation are 1%, and government bond yields are at 8%. Then there's a premium in there, or a part of that price is linked to the expectation that you're not going to get your money back. So my point is that if you look at government bond prices today, there's nothing in the price that states that the market is concerned that you're not going to get your money back. So that to me is just a narrative that's circulating in markets. So hopefully that's just giving you a bit of insight into that. We don't think this is a Liz Truss moment. We think inflation comes down, government bond yields will behave because governments are actually trying to tackle their debt. And ultimately, if inflation is coming down and people are tackling the debt, it means that central banks have this pathway to continue cutting interest rates. And we've seen that this year. So the Fed has begun to cut interest rates again. And we're looking at Europe have kind of cut rates quite a bit and they've kept them on hold, but they might start to cut again. And we definitely think the Bank of England will also start to cut again. So we get these rate cuts coming through, and generally that's good for markets. Now, that's kind of the market update piece. So hopefully that's just giving you a bit of insight into, look, fundamentally, don't really react to one data point. There's a lot of narratives and stories in markets. Most of them are untrue. You have a story and then it moves to the next story and the next and the next. And it's our job to look through that to see actually what's real and what's not, and what should we react to and what should we not. So kind of rational, logical investing. We're moving to this world of transactions where we're seeing governments becoming more corporation-like, starting to run the government, in the interest of generating profit and growth. And in a sense, that makes sense because ultimately that creates more prosperity in your country. So that's the view, and we're starting to see that definitely in the US, definitely in China, and now Europe is taking note because they're thinking we don't want to get left behind if there's this new tech which is going to drive growth. We need to be able to participate and embrace and see how we can drive the growth in our economies, which will help to reduce government debt. I'll just do a little bit of, kind of what does that mean? So what we do is we put together kind of central cases. So what do we think is the most likely thing to happen in markets? So we think our central cases and 65% likelihood that we get a moderate slowdown in growth, we get inflation falling to target, gradual reduction in interest rates. That's good for equities, bonds, and it's mildly positive for cash. And that's kind of been pretty much the story this year. Despite all the volatility, that's been the story. And bonds really starting to come to life in the last couple of weeks as central banks started to talk about, oh, maybe we need to cut rates a bit more. But what if we're wrong? And some of the data points that came out this year kind of flagged that concern. So people are very concerned about the fact that markets have gone up quite a bit and therefore a little bit twitchy on what if things are worse. And this often happens in the investment cycle. You come with up that strong initial bounce, then you get skepticism. That's the first point. And so a lot of people are skeptical today, which I take as a positive because it means that we're nowhere near the top. Because when everybody's banging the table and telling me AI is where we should all be invested, that's when you need to be concerned. And we're nowhere near that today. But we think the likelihood of a recession is very low. And we've reduced that. At Liberation Day, it was higher, but all of these trade deals have been signed. So it's lower. Inflation is falling. Central banks are cutting rates. In the US, they're likely to start implementing tax cuts next year because you've got midterm elections in November and the Trump administration wants to win them. So they will give some tax giveaways. So that will be positive for markets. So that's what kind of markets are looking towards as we move into next year. So what that means is from an equity perspective, look, actually, we're neutral. We think, there's no reason to be overly concerned today, and fixed income Similarly, we did have an overweight in alternatives. We had gold. If you want to ask me about gold and why we sold it, happy to answer that question, but we have exited our position in gold. And just before I finish up, I'll just give you a quick recap of kind of what we do and how we do it. But as you all know, we've got 4 portfolios: adventurous, balanced, cautious, and defensive. And if you look at our portfolios, generally, they're leaning more globally than any specific bias. We're a UK house, but we operate international funds. And therefore, the bias is towards a globally centric portfolio. So you've got a healthy allocation to the US, but we are still underweight relative to MSCI World. But the great thing is you get diversification in there. So it's not all about the US. You've got Europe, Japan, Asia, emerging markets, etc. Everything is about performance from an advisor perspective. Ultimately, that's my role, is to ensure that we've got a team and a process that delivers performance. And performance for our range has been consistently good since launch, and I attribute that to process. Ultimately, process drives performance, but it needs to be disciplined process to drive performance. So we really adhere to what we're doing. And you can see over the 5 years for our adventurous portfolio, it's delivered 60%, which is quite a healthy return, which we're really, really pleased with. And the team has worked extraordinarily hard. And we've got a lot of happy clients as a result. I think risk and reward is also important. This just gives you a quick scatter on what that looks like, but you should expect that trending up. And you're taking more risk, you're getting more reward, which makes sense. And the last quarter has been particularly good for our funds. So at the top end, delivering 8%, at the bottom end, delivering 4%. So healthy returns this year. And just a quick bit on contribution. Much of that's coming from the US over the last quarter. We've seen really, really strong moves coming through, but some other elements contributing to returns, such as Asia. And just before I finish up, just a couple of bits on the activity in the portfolios. So we did hedge some of our US position, and happy to answer questions on that if anybody has them. We sold a position called GQG US Equity Partners because they went too defensive too early in the portfolio, and we felt that was the wrong thing. We did sell some UK government bonds because even if we're not concerned about the fact that we don't think it's a Liz Truss moment, we know that the market can be. So we said, okay, well, let's reduce some of that risk in portfolios, but we still like government bonds, but we're more towards 10-year than super long. And just lastly, behind any great product, there's a great team. So this is just a quick reminder of the team. Now, I'm happy I've thrown a huge amount of information at you in a very short period of time, but I'm really happy to take any questions that you might have.
Thanks a lot for that, Nathan. Very informative as always, and helps clear some of the fog and the mist that hides some of those fundamentals behind the scenes there. As you say, quite a lot of information in there. So rest assured, everybody, there will be a recording of today's session sent to you afterwards. So you will have the ability to watch again at your leisure or focus in on any of the key slides that you want to share with your clients. I'm really pleased to say we've had a whole host of questions get fired into us. So we'll get straight through those, Nathan, if you don't mind. First, we're looking at the question here about how different do you think the next 12 months will look compared to 2024 in terms of what's really driving the markets?
Okay, so if I think about that for 2 seconds, so I think we've had a very strong bounce in markets post-Liberation Day. And now we have a lot of investors kind of skeptical about the next, where do we go to next? So I do think that for the big tech companies, what you're likely to see is some consolidation. So I don't expect their prices to continue to go up at the same level, but neither do I expect them to come down. So we saw this towards the end of last year where they kind of traded sideways for a period. So I expect you begin to see that happening for the big companies. And then for the companies beneath that layer, because you've got inflation coming down, you've got interest rates coming down, and you've got a more positive backdrop, as in particularly in the US, trying to drive a little bit of growth in the economy through tax cuts, etc. That'll be good for those other companies. And we expect other companies, so we call it a broadening out of participation, other companies to begin to participate. So I think next year will be a bit more about catch up for other areas of the market, be that mid cap, small cap, etc.
Great stuff. A couple of questions on gold, as we expected.
Yeah.
One saying, interested to know more about your thoughts on gold, and another saying, why have you sold gold down? Are you now neutral?
Yeah. Okay. So if I think of gold, now the thing about gold is you can't value gold. So if I have a company, I've got a product, I'm selling that product, I can count how many sales I've made, so I can put a valuation on the company. For gold, it's just a piece of metal. So it doesn't do anything. It doesn't give you an income. People buy it because they believe in it as an asset, as a store of value, because it's been used as a currency for over 4,000 years. So if you think about it, basically, if I was a car maker and you were a farmer, basically, and you wanted to buy a car from me, I would say, okay, well, this car is worth 1,000 apples. And basically, the car maker, I say, well, I actually don't want 1,000 apples. I only want 5 to eat for my lunch this week. So we need something as a means of exchange, a unit of account, so that we can agree what's what. And that's what money is. Money enables us to transfer goods and services. So why are people buying gold today? So they're buying it for a couple of reasons. So firstly, because the US government in 2022 sanctioned Russian assets. So Russia had US government bonds, and the US said, you've invaded Ukraine. We're now keeping these because you've been bold, basically, in a sense. And if you were a central bank anywhere in the world, you would say, look, we now have a risk. If we buy US government debt and our relationship with the US is frosty in any way, then they could confiscate our assets. So if you're at the Chinese central bank, you're thinking, well, our relationship with the US isn't great. So maybe we should stop buying their government debt because we might not get that money back. And that's what's happened. So that's the first thing that drove gold higher because you're seeing central banks now buying gold instead of government bonds, particularly the Chinese central bank. The other reason gold goes up is because of inflation. And we've had lots of inflation. Now, the other reason gold goes up is because it holds its value over time. So you think if governments are printing lots of cash, then I want to hold some gold because that'll go up in value because I think that governments are printing too much money and they've got too much debt. Now, what's happened recently is that if you look at the Trump administration, it's trying to negotiate peace agreements around the world. So that takes away some of the sanction risk because actually, if you get a deal between Russia and Ukraine, maybe the US lifts those sanctions and gives Russia back its money. That'll be part of the package. So I think some of that now people are thinking that's likely to happen. That's why I'm saying actually gold has stopped going up because maybe they get a bit more friendly. Inflation has come down. It stayed down. Doesn't look like it's likely to come back up. People were thinking tariffs equals inflation. That hasn't happened. So there's a bit of that coming out of the price. And the last thing I would say is that because central banks were buying and because the price was going up, retail investors were getting involved. And that's usually a bad sign when, moms and pops are just buying gold because why are you buying it? Because it's going up. That's the only reason. And we saw there was a picture, and I did a chart of the week on this, and there was a picture in the FT in Australia, there was a bank that issues gold, and there was people queuing up around the corner. And when they were asked why are they buying gold, some of them said because the price is going up. So whenever you get that happening and you get people buying gold ETFs, which are leveraged, which gives you 2 or 3 times the exposure, you know that that's not good behavior. And if you look at the flow into gold ETFs last year, it was 10 billion. This year was 64 billion. And a lot of that happened in the last 2 months because it was all retail investors. So the way to value gold is by using technicals. So there's one called RSI, Relative Strength Indicator or Index. And once that gets to an extreme level, you should be selling. Once it gets to a cheap level, you should be buying. It's at an extreme level, we have sold because it's one of the metrics you can use. So we're using technicals. We are likely to buy back because we believe in the long-term story, but today it's oversold and there's too much speculation, which means actually the price can fall more if people have leveraged ETFs. So hopefully that gives you a little bit of insight, but there's a lot of mechanics in there, but some of the reasons that we're driving the price have come off a bit.
Great stuff. Thanks for that, Nathan. Couple of questions on a similar theme as well here. Do you think markets today are more influenced by sentiment and narrative than by fundamentals? And also, do you think markets are currently overreacting to political and policy headlines? If so, how should long-term investors position themselves and possibly just do nothing?
Yeah, and I think that's a great question. And I do think that this is going to be a huge problem and it's only going to get worse. So we live in a social media world. I saw an interesting statistic that said that 50% of the content which is now generated on the web is generated by AI. So, when you go onto a website somewhere and there's some article about left, right, XYZ, and it pops up and you click on it, it's been generated by AI, not by a journalist. So the interesting point there is that if you look at the information which is being produced today, there tends to be a negative bias within the information. So it tends to be, a bad story. Why is that? Because if you click on it, it generates advertising revenue for somebody. So somebody in the company said, okay, well, we did some positive articles and we didn't really get much click through, but we did these negative articles and we got a lot of click through and it generated a lot of advertising revenue. So we need to do more of that. So what you'll tend to find is that, particularly on social media, you've all these various different views, people, influencers issuing information as well. So that just creates a landscape where we'll get bombarded with so much. So from my own personal perspective, what I do is I just invest every month. I do not have an app for my valuation on my phone. because I don't want to look at it every day. Because if I do, it'll cause me to make an emotional reaction, particularly when something like Liberation Day happens. What do you want to do the next day? I've got to sell because it's chaos. There's going to get this inflation and the world's going to end. That's the thought process. And that's an emotional thought process. So to remove yourself from that, you just have to have a strategy. And that strategy is that long-term compounding over time adds value. So it's about setting your strategy and sticking to your strategy and not getting distracted, because we live in this world of distraction.
Great stuff. And last but not least, unless anyone else poses a question, you talked about the US transactional industrial policy and Asia's deal making. Which regions do you believe are best positioned to benefit from these shifts over the next few years? And where would the UK fit into this as well?
Yeah, it's a very interesting one. So there's a research piece by Goldman Sachs, and so the belief is that we move to this kind of bipolar world in a sense. Um, so if you look what's happening, basically China has a long-term strategy for growth, and the US has really kick-started into the gear over the last year to try and say, actually, we need to have a long-term strategy for growth as well, not just a 4-year presidential cycle. Um, so this is why the US is linking its currency to digital coins. It's why it's investing heavily in tech. So I think it's almost a two-horse race. It's China and it's the US. And I think for Europe, Europe will be caught in the middle. And over the next couple of years, Europe has the option to trade with both, best of both worlds. But I think over time there will come a point where Europe will be asked to make a decision between one or the other. It'll get drawn into it. It'll get a lot more political. I don't think we're there yet, but that's the direction of travel. So more recently, you had the negotiation between China and the US on rare earth minerals. Interesting, that deal has just been signed for 1 year. And that deal will expire just before the midterm elections next year in the US. So it'll be used as a political tool against the US. And the US is very aware of this. So what they'll do is they need to secure rare earth minerals. So I think there'll be a lot more focus on trying to ensure that regions are secure and they don't have to rely on other regions. And that'll be specific for the US and China. From our perspective today, that creates an opportunity to buy from both. So from an investment perspective, it creates more opportunity because they'll be both trying really hard to drive their own growth, which is good for asset prices in both of those regions.
Excellent. Well, no further questions from the floor, Nathan. And I think an indication of how everyone's been hanging on your every word. We only lost one person from the start of the session to the end of the questions there. So lots of useful intel for advisors to use with their clients. As I say, there will be a recording made available in the next 48 hours. Feel free to share that with any of your colleagues who I'm sure will find the information equally useful. And just leaves me to say a very big thank you to Nathan for all the information you've given us here this morning in your presentation. As I mentioned at the start, the Marlborough solutions are available on the Novia Global platform. If you need any further information, you can contact me or your usual international sales manager, and we'll gladly put you in touch with Nathan and the team. We will be sending out an invite shortly to our next Novia Global Pulse webinar. And of course, with the budget in the UK coming up in a couple of weeks' time, if there are any significant announcements made there, we'll probably try and shoehorn in a quick overview for that as well. So that just leaves me to say thank you again, Nathan, and thank you again, everybody, for attending, and see you again shortly. Thank you. Goodbye.
Thank you.